Welcome to WealthEchelon, your go-to spot for smart investing, in-depth ETF insights, and book reviews that help you build wealth. On this channel, we explore everything from the best investment strategies to the latest trends in ETFs and provide valuable takeaways from books that can transform your financial journey. Whether you're a beginner or an experienced investor, our goal is to give you the knowledge you need to make informed decisions and grow your wealth. If you're ready to elevate your financial game, hit that subscribe button and don't forget to turn on the bell for updates on all our latest content. For many investors, especially those new to the world of building wealth through the stock market, finding a strategy that is both simple and effective can feel overwhelming. Endless financial jargon, market volatility, and economic uncertainty often lead to hesitation or worse, poor timing decisions. But in the noise of high-frequency trading, technical analysis, and speculative bubbles, one quiet, steadfast approach has proven itself time and time again: dollar cost averaging, DCA. When applied to exchange-traded funds, ETFs, DCA isn't just a technique, it's a long-term wealth-building machine that beats most market timing efforts and keeps investors calm, consistent, and confident. In this exploration, we'll break down why dollar cost averaging ETFs is not only practical, but why it nearly always wins over the long term. The psychology of timing versus the power of consistency. One of the greatest enemies of the average investor is emotion. Fear and greed cause panic selling at market bottoms and euphoric buying at market tops. Time and again, studies show that individual investors dramatically underperform the very funds they invest in, not because the funds are flawed, but because their timing is. Dalbar's annual quantitative analysis of investor behavior consistently finds that investors earn far less than market averages simply because they jump in and out of investments at the wrong times. Dollar cost averaging eliminates this problem by removing emotion entirely. The investor commits to buying a set dollar amount of a given ETF, say $500 per month, regardless of the price. When the ETF price is high, that $500 buys fewer shares. When the price is low, that same $500 buys more shares. This strategy flips fear and greed on their heads. Investors buy more when prices are low, bargains, and less when prices are high, expensive, automatically. Over time, this builds discipline and consistency, two ingredients far more valuable than any market prediction. This steady psychological advantage is why dollar cost averaging is beloved by financial planners and successful individual investors alike. There's no need to worry about, is the market too high right now? Or should I wait for a pullback? Questions that no one, not even professional fund managers, can reliably answer. The math behind why DCA wins over time. Beyond investor psychology, the math of DCA gives it an edge that pure lump sum investing sometimes lacks, particularly for those without a large initial capital. Let's take an example. If an ETF is trading at $100 per share and an investor commits $1,200 annually at $100 per month, they'll purchase shares at various prices as the market naturally fluctuates. Imagine the ETF price moves like this during the year: $100, $95, $90, $85, $80, $85, $90, $95, $100, $105, $110, $115. When the price drops, the investor buys more shares. When it rises, they buy fewer. The result? A lower average cost per share compared to simply investing a lump sum at a single point in time. This effect, called the DCA cost advantage, means the average price per share over time is less than the average market price. And because ETFs are inherently diversified, this principle applies beautifully without the risk of total failure that an individual stock might carry. Most backtests on broad market ETFs like VOO, S&P 500 ETF, or SCHD dividend ETF show that DCA performs competitively with lump sum investing over time, but with far less risk. While lump sum may edge out DCA in perfectly rising markets, real-world markets rarely rise smoothly. Volatility ensures that the investor who keeps buying regularly often comes out ahead by taking advantage of market dips. something lump sum investors can't do unless they can time the market perfectly, and almost no one can. The best ETFs for dollar cost averaging. Not all ETFs are created equal when it comes to dollar cost averaging. Broad market index ETFs like Vanguard's VOO or IVV, both S&P 500 ETFs, are ideal because they offer instant diversification and low fees. Their long-term track records show that they nearly always recover from market downturns and continue to grow as the economy expands. This historical trend makes them perfect for a DCA strategy that thrives on volatility and long-time horizons. Dividend-focused ETFs like SCHD or VYM, Vanguard High Dividend Yield ETF, are also excellent for dollar cost averaging. Why? Because not only does the investor accumulate shares at varied price points, but they also enjoy growing dividend payments that are reinvested, compounding returns even faster. In periods of market decline, the dividends still pay out, buying more shares at low prices and accelerating the recovery curve. International ETFs, such as VXUS or emerging market funds, offer another layer of diversification that fits well with DCA strategies. These funds are often more volatile than U.S. markets, which means more buy low opportunities for DCA investors. Over a decade or two, these purchases at depressed prices can dramatically lower the average cost per share and enhance future returns as global markets recover. Finally, sector-specific ETFs like QQQ, tech-heavy NASDAQ 100 can also work with DCA if the investor has a strong belief in the long-term growth of a sector, like technology, healthcare, or clean energy. However, these are riskier than broad market ETFs and require a longer time horizon to smooth out sector-specific volatility. Risk reduction and peace of mind, the hidden value of DCA. Perhaps the most underrated benefit of dollar cost averaging ETFs is peace of mind. For many investors, the stress of when should I buy or what if a crash happens tomorrow paralyzes decision-making or causes panic moves that harm portfolio performance. DCA removes this anxiety. You're always buying. High market? Fine, you buy a little. Market crash? Great, you buy more. This approach is especially valuable during market crashes. History shows that investors who DCA into ETFs during bear markets or recessions, like 2008, 2020 COVID crash, or even the 2022 tech sell-off, end up with incredible long-term gains because they were buying cheap shares when others were fearful. DCA investors don't need to call the bottom. They naturally average into it. Moreover, DCA fits perfectly with salary-based income. Most people get paid monthly or biweekly. Automatically investing a portion of each paycheck into ETFs allows wealth to build effortlessly in the background. No need to save up thousands for lump sum investments. This peace of mind is also quantifiable. DCA reduces portfolio volatility over time. By spreading purchases out, the investor avoids the risk of investing a lump sum at an unfortunate market top. While this may slightly reduce absolute returns in straight-up bull markets, the reduced volatility and emotional stress more than make up for it in real-world scenarios. Long-term wealth building, why patience with DCA pays off. The true magic of dollar-cost averaging ETFs reveals itself over 10, 20, or 30 years. As time stretches on, the advantages of DCA, lower average share cost, reduced emotional mistakes, compounding dividends, and broad diversification, compound into serious wealth. For example, someone who started DCA into an S&P 500 ETF like VOOO in the early 2000s would have bought during the dot-com bust, the 2008 financial crisis, and the COVID crash. Each of those terrifying events offered the DCA investor low prices that later turned into huge gains as the market recovered. Even during the worst moments in recent financial history, the DCA approach kept the investor buying low, silently laying the foundation for future wealth. Data backs this up. Morningstar, Fidelity, and Vanguard studies consistently show that investors who use DCA into broad ETFs build substantial wealth over decades, even more so than many who try to beat the market by guessing tops and bottoms. Time, not timing, becomes the greatest ally. Furthermore, The compounding power of reinvested dividends in ETFs like SCHD or VYM adds an additional growth layer. Over decades, these reinvested dividends buy more shares at varied price points and result in larger future payouts. A snowball effect that can turn modest monthly contributions into 6- or 7-figure portfolios. Even inflation-resistant assets, like real estate or commodity ETFs, can benefit from DCA when used carefully, allowing investors to protect their portfolios from currency devaluation while enjoying the same systematic buying advantage. Lastly, retirement accounts like IRAs or 401ks are tailor-made for dollar-cost averaging into ETFs. Tax advantages, automatic paycheck deductions, and long-time horizons make these accounts ideal DCA environments where slow, steady contributions build retirement security without constant portfolio tinkering. In conclusion, dollar-cost averaging ETFs is not merely a method of investing, it is a mindset. It replaces anxiety with confidence, guesswork with certainty, and short-term fear with long-term purpose. The strategy aligns beautifully with real life. Income arrives monthly, so investments can too. Markets rise and fall unpredictably, so regular purchasing captures both peaks and troughs. Investors remain human, emotional, impatient, sometimes irrational. So DCA removes the need for precision and perfection. No, DCA isn't magic. It won't make you rich overnight. But history and mathematics prove that this humble, quiet approach beats most other strategies in real-world practice, especially for average investors building wealth slowly but surely. By spreading risk, lowering average cost, and making investing habitual, dollar-cost averaging ETFs quietly wins in the background, growing accounts steadily as the years roll by. As Warren Buffett said, the stock market is a device for transferring money from the impatient to the patient. With dollar-cost averaging, patience is automatically built into the process. For anyone serious about long-term wealth creation, there may be no simpler and no more powerful strategy. And that's why dollar-cost averaging ETFs nearly always wins long-term. Thank you for watching Wealth Echelon. We hope you found valuable insights that will help you on your investing journey. If you enjoyed the video, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss an update. Keep building your wealth, and we'll see you in the next video. Don't forget to check out our other videos for more investing tips, ETF strategies, and book reviews to continue growing your financial knowledge.